Hey. Hey everybody, if you're watching this, you're watching the replay, pay attention. Oh, this is the camera right there. This is Matt Jensen, he's my CPA. Watch through, he'll explain taxes and then answer questions at the end, and hopefully that's good enough for all of you. So, hey everybody, invite your teams, share. This is your time to get answers about taxes from a real live CPA. Without paying them money. If you go another time, you might have to pay money. What am I doing? Oh, there we go. That's better. Hi, everybody. Welcome. Good morning. Hopefully you guys slept more than I did last night. I'm not going to lie. I went to bed like 4:30 this morning because I was trying to approve people and do my party and everything. And I set my alarm for early. Well, I set the time for early, but then I forgot to turn the alarm clock on. So this is me. Okay, welcome everybody. Welcome. He is so excited. This is his first live video, and I told him there would be like thousands of women and a few guys on here. So exciting. He cannot wait to tell you all about taxes and getting yourself being safe with the IRS and getting huge tax deductions, right? That's why CPAs are good, guys. CPAs are actually your friend. It's the IRS you want to be careful of, right?
Right.
They don't play. They do not play. So, okay, share. If people can't see this when you share it to your groups, it means they're not in my group. So they have to be in my group to share or to see it. If they can't see it, have them request to join and have them write their consultant number. That will get them approved a whole lot faster. And then they can always come back and watch the replay. All right. Good morning, everybody. Welcome. See, 150 people are on. He's so excited to see the numbers go up. He's so excited. This is his thing, is going live in front of a bunch of people talking about taxes. They're so excited to hear from you.
I was telling Michelle earlier, this is actually my first video live event like this, so it's new to me, so it might be a little choppy at times, but I'll try and do my best. So.
And like I even said, do you want me to add you on Facebook so you can read all the questions? He's not really on Facebook much either, so this is like a whole new thing for him. Give him lots of hearts. See, look at hearts, thumbs up. You're with a nice group of ladies and some guys, huh? Okay, yay. Okay, you guys, we'll get going. Okay, there we go. I'm on. Okay, oh, they love you. See that, hearts? Yeah, that means you're so cool.
Nice.
Okay, so let me introduce him. Then he is going to teach a class, basically, on what you can deduct and answer questions about when to file, how to... your stuff that you need to know. And then at the end, you guys, if he does not answer your questions, then you can ask, okay? We're not going to be reading questions and asking throughout because he has like a format he's going to go through. So please just hold your questions, write them down if you have one or if you think of one. And if he doesn't cover it, then ask at the end. But if he covers your question, cross it off because he doesn't need to answer every question 5 times. All right. Yes, 214. Okay, I said when we reach 200, we'll go live. So let me introduce this nice person. His name is Matt Jensen. He actually lives just a couple streets over from me.
Yeah.
We didn't know that when we moved here that we were moving closer to our CPA. But I mean, he's super excited. Who wouldn't want to live closer to the Johnnies?
It's true.
And he loves us because our taxes are so much fun.
Oh, yeah.
Let's just say our taxes are a little bit complicated because of our multiple streams of income that we have coming in with everything. So we're only going to talk about paparazzi today. CPAs are great because if you're like us, you try to deduct as much money as you can so that you don't pay as much in taxes, you guys. I always tell people there's 3 reasons that paparazzi, or there's 3 or 4 ways you make money with paparazzi. The first way is in your sales. Okay, you make money when you sell paparazzi. The second way is you make money when you share it with other people and they join your team. So that's number 2. The third way you actually make money with paparazzi is in your taxes. Okay, Because if I guarantee you, if I made as much money as I did without a home-based business, I would be paying more taxes than I am because this is a home-based business. So I remember the first couple of years we were in Paparazzi, we actually got a lot more money back in our taxes than we would have if we weren't in a direct sales company. So it's not that the government is paying you money to have a home-based business, it's that they're not taking as much money away from you. So like the year my husband quit, the first year my husband quit his job, he quit in June. So he only paid taxes on, his 6 months working at the university, and then we had some rentals and, the other places where you pay taxes. And I said to Chris, we are going to have to pay so much in taxes this year because we made so much money and we never paid taxes, or at least that's what I felt like. And we got $10,000 back in taxes, which was more than we got back the year before when we made less money. And it's because we had a home-based business and we were able to deduct a bunch of stuff. So pay attention, because he will make you money, guys. Make you money, as in save you money, if you pay attention and do what he tells you to do. Do you guys get that? Do you get... if you're married and your husband has a job, or if you have a second job, you can actually, if you're, how you're paying money on that, you can actually keep more of the money that you would pay on your other job because of your home-based business. So I have friends that are lawyers, and he's a lawyer, she's a professor, and they always want a home-based business because they want to deduct as much money as they can from their other jobs to try to save them money. So pay attention. Not only can taxes make you money per se or save you money, but a good CPA will keep you out of trouble. So we do not do our taxes by ourselves because they are complicated, and we don't want to be audited by the IRS. A CPA can help keep you out of trouble. If your taxes are simple, then you don't always need a CPA, but if you're deducting a lot, you need one. So I'm going to turn it over to Matt. He's so excited. Just listen, and like I said, at the end, feel free to ask questions that he does not answer as he's talking. All right.
Well, I'm excited to be here. As Michelle said, my name is Matt Jensen. I'm a local here in Logan, Utah. I'm a certified public accountant registered in Utah, and I also just received my designation as a certified valuation analyst as well.
I don't know what that means, but it sounds important.
That designation allows me to value a business. If someone were to buy, sell a business, or to gift a business, something like that, a valuation needs to be done in order to get you the most for your money or IRS requirements. I've been at the firm I've been with for 5 years now. I've worked with Chris and Michelle for that long. So known them for a little while, and I'm glad for this opportunity to kind of help Michelle and those of you that are watching.
And just so you know, you guys, he knows Paparazzi makes money. Huh?
Oh, yeah.
Because he's seen our taxes. He knows that Paparazzi is a good business to be in.
Yep, it is, definitely. I'll go along with what Michelle was already saying about having a home-based business. It lets you deduct other things that weren't possible earlier. So myself, I'm an employee. I don't have a business, and so I can't deduct stuff like my phone and my car, stuff at my house that I use when I'm actually still doing work for my employer. But as a owner of a home-based business, you have those options of deducting those things you do use in your business. You do use to carry on your course of business. So having your home-based business definitely is a plus.
You know, Matt, you could sign your wife up to be a consultant, and then you could have a home-based business.
That's true.
Right? Don't you think? Look, they're we should have put something. They want you to wear some jewelry. We'll get some Mardi Gras beads or something. Oh. Okay. When's Mardi Gras? Here we go. There we go. Nice.
Better, everyone?
Yes.
I hope so.
Okay.
So, I wanted to start off, Michelle printed me off a list of questions that people have been asking the last couple days. Some of what I've talked about is based off those questions, and they're
loving you. You probably can't see all the...
So one question I wanted to start with was a lot of people ask when do they need to file taxes for Paparazzi? The first easy question is if you ever get a 1099, you need to file. The IRS has got a copy of that 1099 and they're expecting you to file. And if you don't, they're going to charge you the most amount of tax based on that 1099 you received. So if you receive a 1099, which companies are required to send out after you earn $600, definitely need to file. Now, sometimes 1099s aren't correct. You know, you've been able to do a couple $1,000s of sales and you still haven't received a 1099. That $600 limit is still the limit. You should still file once you've made more than $600 in gross sales.
So you guys, I'm going to interrupt.
That's just fine.
Okay, so there's a couple things here you need to think about. Paparazzi will send you a 1099 if you made $600 or more in commission from them. This does not include your sales. So from your teammates below you or bonus qualifications, basically, or from your website. So if you get over $600 in commission from Paparazzi will send you a 1099. That does not include your personal sales. So you should be keeping track of your personal sales, how much you're making there. Just because Paparazzi doesn't send you a 1099, does that mean you don't have to file?
You should file. And if you're ever audited, the IRS requests your bank statements, they would nail you for it.
Okay, so you should be keeping track of your personal sales. If you made over $600 profit, now remember your profit is the $225, not the $5. There's a difference between selling $600 and making $600 profit. If you make profit over $600, then you should file.
Right.
Or between the two. If you get some in from Paparazzi and some from your home, you should file.
Definitely. Another thing is, so say some of you just started your business this year, you've only done $400 or $500 in sales, but say you bought $1,000 of inventory, and I mean, I'm not certain the whole startup for what you do with Paparazzi, but getting advertising going and such like that, you spend $2,000 and you only made $500. Well, you can deduct that additional amount over the $500 you made, but you have to file to deduct it. So say you file your return, you made $500, but you say I don't want to file. You got a zero from the business, a net nothing. But say I'm going to file, you got $500 of income, $2,000 of expenses, you got a $1,500 loss, which can be used to offset other income on your tax return. So if your spouse is working, that $1,500 can offset their W-2 income, which is one way to help you save more money. Usually you can't you have very few options to write off W-2 income. So a business income can offset that. So if you've got a bunch of expenses, I would definitely say file to get the deduction for it for sure.
So you guys, did you hear that? Even if you didn't make $600 in profit, it makes sense to show that you lost money with your business because you're going to get more money back from the other places you pay taxes. Taxes are a good thing with a home-based business. I tell people that all the time. I don't think they get it. If you're married or if you have a second job or if you're paying taxes elsewhere, you want to show that you're losing money, right?
If you're really losing money, you want to show it. You want to get the benefit of it.
Right.
So don't be afraid to file if you lost money. Some people are scared that if I have any sort of loss, the IRS is going to come after me, and that's not the case. The IRS realizes some businesses lose money. Sometimes they look over it over a course of several years as well. One of the kind of rules of thumb for the IRS is as a business needs to show a profit once every 5 years. So some people in the past have tried to set up a business where every year they have a $10,000 loss, and they've done it for a decade. And the IRS is like, well, if this is a real business, you'd be changing how you do business to make money, which is true. But just because in some years you have a loss doesn't mean you're not a business. So if you have a loss and you're doing all you can, let's show the loss, save you some money, and reduce your tax liability. So.
And just realize, because of what he's going to talk about, a loss doesn't always mean, like a loss on paper doesn't always mean a loss in your pocket. Because you can deduct miles and things like this that show that you're losing money, but you're not really losing money. Do you know what I mean? Mm-hmm. So we love to lose money on our business because that means we get more money back in tax, or we don't have to pay as much in taxes.
Right, correct. Another thing I just thought of, someone asked a question that Michelle printed out, asked if this information is going to be useful over the whole United States or just Utah. I forgot to answer that right away. I will talk about everything that is useful in every state in the United States. There will be a couple things that will kind of be state specific, and I'll point those out when I talk about them. So those of you that aren't in Utah, you know that most of this information I'm going to say is for everyone in the United States. So
they're complimenting you. They say you look fabulous. We go to church together. Don't you think he should wear this to church? I mean, whoo, that in a suit. Nice. He would get a lot of attention, people. Lots of attention.
All right. So I think I'm kind of finished on the topic of when to file. So I'm kind of going to move on to entity structures. Those of you that are just starting a business, if you haven't made a lot of money, I would not suggest going out and setting up a partnership or S corp right away.
Or an LLC.
Or an LLC. So an LLC is a state entity, and for the IRS, it's either taxed as a partnership or an S corp. So LLC, kind of have to be careful. You have to specify when you say it's an LLC taxed as a partnership or an LLC taxed as a S corp. So you've got three main structures. You have a sole proprietorship. It's just you doing business and you don't have a business set up. You have a partnership. You need to have two people to have a partnership. So husband and wife, you and a friend are doing it together, you can do a partnership. Or an S corporation. You can have a single person as an owner of an S corporation. And each of these have different benefits to all of them. So I'll kind of start out with, say, the new business owner. You made $10,000 in sales. I would suggest being a sole proprietorship, which means you file your business tax return on a Schedule C on your 1040 or your individual tax return. So you're not filing a separate business tax return, just an additional schedule on your personal tax return. Saves you money. You don't have to file another tax return. So I mean, most CPAs would charge, I mean, if you go to H&R Block, you're not going to get the best service there. They might charge $150, $250. If you go to an actual CPA, you're probably looking anywhere, I mean, CPAs vary widely, but you could look anywhere from $300 to $2,000, depending on your return, the complexity of it, and the CPA in question.
And let me just say, in our case, he is worth every penny that we pay him.
I appreciate that.
Okay? And I always say this, a good CPA will save you the money that you pay them to do it. Plus, if you ever get audited, your CPA should come in and go to bat to you, right? If you use the same person over and over and over. If you go to somebody that's just, set up at a store, because I know like Walmart or places will have a CPA sitting, not even a CPA.
They don't have to be CPAs.
Just like some person they hire to do taxes. You guys, I'm not meaning to put people down or whatever. Those are not the people that are going to help you the most. They're going to do the bare minimum for you. Don't you kind of feel like that? So a good CPA will make their fee worth it.
Mm-hmm. And going along, kind of like you said, sticking with the same CPA will help you over time. If you're every year changing your CPA doesn't have a chance to see what your business has done over a couple of years and give you ideas and suggestions and such. So if you're switching CPAs every year for price even, or if you move a lot, it's going to be a lot harder. Every CPA can do taxes anywhere in the United States. So even if you have a CPA that you trust in Texas and you move to New York, if you still trust that CPA in Texas, I would still I'd mail your stuff in the mail to Texas to that CPA and let him continue to help you. So as long as you have a CPA you trust, you feel like they're doing good work, I would stick with them as much as possible.
Okay, so there's a bunch of... I will allow this question. I'll see if I want to ask. So they're asking, how do they find a good CPA? Who can they use? Oh, honey, we got him with beads.
No, Matt, you
We
should have
got-
called me for help, dude.
Uh-oh, Chris is here. He is dressing Matt up in some manly jewelry. Come on, he likes the beads. We said he should wear this to church.
Yeah.
Okay,
should've
so
called me.
Matt, how can
Got
they...
my
Woo! Hot!
Get this off.
Oh, honey, we like the beads. We're celebrating Mardi Gras.
Yeah.
I did
Uh-oh.
watch a movie
I think
about
my
New Orleans
husband must have looked online and saw him, and he's like, I've got to go save Matt. Okay, how can they find a good CPA? Well, first of all, let me say this. I said to Matt, if you come speak, is it okay if people come to you to do their taxes? And he said yes.
Yes.
So if you want him to do your taxes, even though he's my neighbor, you can have him do your taxes, okay? But if they wanted to have a CPA in their own area, what do you recommend for them finding a good CPA over going to like H&R Block?
Yeah. My suggestions, one would be talk to other business owners that you know and ask. Other business owners, usually they've been to at least 2 CPAs, so they have a couple ideas. So I would definitely ask people that you know, who do you trust, who does a good job. I'd look on Google reviews. I mean, sometimes a lot of CPA firms will say, you know, we'll give you a discount if you give us a good review, but you can read through the comments and you can find out who's real through the comments. You kind of get that feel. And most CPAs will do a free half-hour consultation. So if you got one you think you want to use, I mean, you can call up and say, hey, I'm thinking about using you as a CPA. I'd like a free consultation. Almost all CPAs will do that. So you can go in and visit with someone and kind of get a feel for them. That'd definitely be my suggestion there. The number one would be if you got other business owners or friends that have businesses and you task them, who does your taxes? Do you like them? How do you feel? It'd be, I mean, word of mouth's the best.
Can you do a phone consultation with people if they want it?
Yes.
Can you talk to people over the phone?
Yes.
Okay, so if you want to use Matt, if you decide after he talks, like, oh, he knows what he's talking about, he's going to save me money, Michelle trusts him and recommends him, then I want to talk to Matt. He could help you with your taxes even if you don't live in Utah. We'll give you his information at the end, and then, of course, I'll write it in the group. Okay?
Okay, sounds good. So we were just talking about your structure. If you have a small business, I'd suggest having a Schedule C on your personal tax return. It saves you money from not having to set up a business with the state. So hire a lawyer to set up your business, and saves you money on the tax return. And it's pretty simple. It'll just be easier on a Schedule C. So if you have 2 people in your business, or a husband and wife, you're going to be filing a partnership return. It is an additional tax return. You should hire a attorney, or most states let you set up a business yourself online, but it has very few, what are they called now, bylaws or a really good operating agreement. So if you have a partner that's not a spouse, I would definitely suggest hiring an attorney to set up some good articles of organization, some bylaws, in case you and that partner eventually have problems. Mm-hmm. The bylaws are what's going to save you, and you agree to them now. So with a partnership, you're still filing your a separate tax return. All the income gets reported on your personal income still. So the business tax return does not pay its own tax. All the tax is going to be paid at the individual level. And the same is true for an S Corp. An S Corporation, you can have one owner. That does have more requirements. You definitely do want a good attorney to help you set it up. But the benefit of a S Corporation over a partnership and a C Corporation, or a Schedule C sole proprietor, is a partnership and a sole proprietor, all of your net income, so all your income minus all of your expenses is your net income. All that is going to be subject to both income tax and self-employment tax.
Okay, but you guys, Matt, do they need to go do an LLC, S corp, and do they need to go set up a business corporation if their business is smaller?
If it's smaller, you don't need to go set up you don't need to set up a LLC, a partnership or an S corp right away.
When would you recommend that they take their business a little step further in setting up an entity? So listen up, you guys. I know right now some of you are like, deer in the headlights. What is he talking about? Okay, for us, we have, what's this business?
Jewelry for $5
Is an LLC.
It's an S corporation.
Oh, see, this is my husband's job, right? He's the tax guy. He works with Matt. So because we make so much money, we set up this S corp, and that actually helps us save more money.
Correct.
So that's why he's talking about this, is as your business grows bigger, you will want to set up an LLC, S corp, or whatever is best for your situation, which I would recommend talking to a CPA about this. Right?
Mm-hmm. Yeah.
The CPA can help you decide what is best for you, but you don't need to do this until your business is bigger. The reason for doing it is it will save you. You will pay less in taxes if you set it up that way.
Uh-huh.
Okay? So that's why he's kind of touching on this, but don't go into...
Yeah. So when you make about $20,000 to $30,000 in gross sales before your expenses, I would suggest setting up another layer of protection. So a partnership, an LLC, an S corporation. I saw in the comments here someone said that they have a single member LLC. So if Michelle's doing business by herself, she doesn't want to file another tax return, she can set up a single member LLC, which is still taxed as a sole proprietorship, but the single member LLC set up a bunch of legal protections for her. So that's one of the big reasons of setting up an entity as well, is the legal protections it does provide.
So if somebody, let's say somebody got a piece of jewelry and that they choke themselves with it, right? Mm-hmm. And they came after me because we have an S corp, they couldn't go after our house, right?
They couldn't get your house, your car, your personal bank accounts. The extent of their lawsuit is limited to what is actually inside your business.
Okay.
So that's the reason why if you do a lot of sales, you don't necessarily want to keep a lot of money in your business bank account. You want to keep enough to do business, but you don't want to have a bunch of excess money and you're sitting in your bank account that you're not using.
Right, because then they can go after that. So once again, as your business grows, most of you don't need this right now, but maybe when you're hitting, diamond life at the party every year, or if you're a premier producer and above, this would be a good thing to look into, because one, it will save you more money, and two, if something happens and somebody comes after you, they can't take everything from you. If you are just declaring it like you don't have a business entity set up, they can go after everything you own, right? Mm-hmm. You hear of people that go after, lawsuits. We love them, right? We love lawsuits. They go after people with everything. So, okay, don't be too afraid by this. All he's saying is if you make pretty good money with Paparazzi, what would you say, $15,000-$20,000 a year profit?
If you're making $20,000, if you're doing $20,000 in gross sales,
so
I would suggest setting something up.
Okay.
I visit with a CPA to talk about what's going to be the best structure, and then you're going to go visit a lawyer to set it up.
Yeah, you guys, but I don't know anyone in Paparazzi who has been sued from something, but you never know when you're going to meet that crazy person that is going to try to take you for everything you're worth. So just keep that in mind. I would talk to a CPA about this. Don't just go off of what Matt is saying right now. This is something that needs research and thought, not just like, oh, Matt said I need something and I'm going to go do it. Talk to a CPA before you set that up. Okay.
Correct. Okay, kind of going to move on to the next subject. I think we've kind of hit the structures. Just know that if you're getting above that $20,000, $30,000, it's time to think about something, time to visit with a CPA. The next subject I saw a bunch of questions about was inventory. People are asking about counting inventory, tracking inventory.
$20,000 a year, he said, right? $20,000
Yes.
a year. So if you're making $10,000 profit, you should definitely look into structuring a business. Okay, moving on. Okay. Inventory.
So people ask just about tracking inventory. My suggestion, every CPA is going to have a little bit of a different approach to this. My suggestion is if you're turning over your inventory really quick, I mean, if your inventory, you're holding it less than a month, I don't know that I would really track it, count it. If you're holding on to your inventory, if you buy a lot of inventory and you end up holding on to it for a couple months, you need to do a inventory count at the end of the year. Even if you're not turning over inventory a lot, but if you say you're a really big seller and you have a lot of inventory, your CPA is going to want an inventory count on December 31st. What's left at the end of the year? Goes on. It'll go onto the balance sheet of your taxes, and that's the inventory left over is a possible deduction for the next year. So.
If you guys follow me on my personal page or in my VIP group, you see I just did inventory. See all this behind me? Oh yes, look right here in front of you guys. Let's see, can you see that? You guys see my ring and wrap table? Yay! Well, I just went through all the jewelry. So Matt, guess what, guys? I have 8,700 and something. You don't need to write it down. 8,754 pieces of $5 pieces, and then like 1,300 starlet shimmers, and I still need to count my $25 pieces. But I get to turn that number into him, and he gets to tell me how much of a deduction that is.
Yep. So a lot of people had questions just about like how often they need to do a count. And really the answer would be for tax reporting just once a year, really, end of the year. Other people had asked if it needed to be separated, if you need to say, I have X amount of $5 jewelry, I've got X amount of 15. Your accountant's going to just want to know the total number at the end of the year. So if you want to break it down, you can. Your CPA is not going to really care.
They just want to know like the total dollars, right? Mm-hmm. The total.
Yeah, so we want to know if you got $5,000 of inventory yourself.
Right. So Matt, we do the wholesale cost, not the retail cost, right?
What you purchase it for.
Right. So you guys, if you have 1,000 pieces of jewelry and you need to write what you have in inventory, it's not $5,000 worth, it's $3,000 worth for your inventory, right? About $3, every piece times about $3. That's the number you would give your accountant. It's not necessarily the number of pieces. He wants the dollar amount, and it would be the wholesale cost.
Correct. Really good pointing that out. I didn't say that. And that's really all you need to know for inventory. A couple of people had asked also, purchase inventory and it comes damaged. Can you still count that as a deduction? Yes, it is a deduction. You're not gonna, if it's damaged, you're not gonna sell it anymore. It's no longer part of your inventory, but it is it's still a cost. It's a supply or a cost of goods sold that actually didn't get sold, but it's still a deduction. So you want to know that you bought it, but it's no longer part of your inventory that you're gonna try and sell the clients anymore.
Right. So that would be a deduction.
So it's a deduction.
And he'll get to that in a minute.
So it is a deduction. It's a cost. Sorry. Yeah.
It's complicated, guys. This is why a good CPA will help you.
Kind of tongue twister. When I get excited, my tongue twists pretty
good.
Okay,
really quickly, remember how we talked that Paparazzi taxes us on the front end?
Uh-huh.
So they're asking, do we include the cost of the tax that we're charged in? Yeah.
The amount you pay, the amount you write out on your check to Paparazzi, that is what you purchased it for, and you get the deduction for the full amount. Michelle and I were talking about this before we started, so someone have a question, and since we brought it up, I'll answer it now.
Okay.
Some people are asking, can you deduct your sales tax that Paparazzi charges you? And the answer is yes, of course. So say, I was telling Michelle, you buy the piece for $3, Paparazzi charges you 50 cents of sales tax. How do you deduct it? You can do it one of two ways. The easiest way, which most CPAs won't matter which way you do it, is, I bought X amount of goods from Paparazzi. I charged $350 times 1,000. I've got $3,500 of cost of goods sold. Or you can, there were 3,000. Sorry, you had 1,000 pieces at $3. That was the actual cost. So there's $3,000 of cost of goods sold, and then 50 cents times 1,000, or $500 of sales tax. So you can still deduct. You get to deduct the sales tax. It just kind of depends on how you want to track it. If you're actually going to track sales tax from Paparazzi and the cost of goods sold from Paparazzi, if you're just going to track, I paid Paparazzi this for my supplies I need.
Yeah. And the other, well, do you want to, do you want to address right now if they choose not to pay tax or charge tax? Okay, a lot of you have this question, so pay very close attention. You know how we pay tax on the front end. Usually when you buy wholesale, you're not charged tax because tax is charged to final purchase to consumer. Okay, but because of the laws, Paparazzi is required by the government to charge us tax on $5, even though we're only paying $2.75 per piece. Okay, there are some people who choose not to charge their customers tax. I personally don't recommend it. I think you should charge your customers tax. They're going to pay tax at the store, things like that. But there are some that choose not to charge their customers tax, and they want to know. Okay, so we lost in Utah 34 cents per item because we paid our customer sales tax. How does that work for a deduction, Matt?
Okay. So yeah, kind of it's when you purchase the inventory, I mean, you get that deduction. When you pay that 34 cents to Paparazzi, you get the deduction. But so when you sorry.
No, it's complicated.
So let's start with those of you that are just charging $5 flat for your jewelry, and you're not charging sales tax. So what you've done is your income's $5. You purchase the part from Paparazzi we're just round numbers for me, $3 for the supply, 50-cent sales tax. So you got $3.50 you paid for it, and you're selling it for $5. So you got $1.50 of profit in there. Now, if you don't charge sales tax, you ate that 50 cents from the sales tax that Paparazzi charged you. So that comes out of your profit. You get less money at the end of the day. Those of you that are charging $5 plus tax, you're going to charge your customers $5.50, and you bought it for $3.50 from Paparazzi. So you got $2 of profit, where those of you that aren't charging tax have $1.50 of profit. So I would definitely suggest charging sales tax. I would not suggest that anybody eat the sales tax for their customers. Sales tax is paid by the end user, so legally the people you are selling it to, they are the ones that are responsible for it. So
okay, but some of you asked, like, if I choose not to charge tax, I can deduct that money. How much of that will I actually get back in taxes? Remember, we talked about this upstairs. So he's going to tell you. So let's say.
Cool. So say you pay the tax for your clients. At the end of the day, you paid $5,000. At the end of the year, you paid $5,000 in sales tax for your clients.
$5,000, guys. Let's say you sold enough that you paying all your customers' taxes would have added up to $5,000 of profit had you charged them tax. Because remember, you paid their sales tax. Nice thing to do. Super nice. Not very profitable.
So
how much of that $5,000 would you actually get back because it's a deduction?
So it's a deduction. So long form, say you had $50,000 of sales or net profit, and then you had the $5,000 tax you paid. You got $45,000 of income. That flows through to your personal return. If $50,000 is all your income, you're in the 15% tax bracket. So 15% of $5,000 is $750. That is the amount of tax liability reduction you're getting for paying the $5,000 of taxes to your clients.
Okay, so all of you that think, oh, well, I'm gonna pay all my customers' taxes, and then I'm just going to deduct it, and I'm going to get the money back. You're not going to get the $5,000 back. Just because you deduct $5,000 does not mean you get $5,000 back. If you were in the 15% tax bracket, which, guys, I don't know that much about brackets and blah, blah, blah. That's why you CPA. You would get about $750 of the $5,000 back. So realize that. Okay, if you are in this to make money, you charge your customers tax. And every once in a while, you can do a tax-free sale. Woo! Yay! There is a way to do specials with Paparazzi, and that's when you charge tax, and every once in a while, you don't charge tax. But if you never charge tax, you can't go do very good deals, guys. Okay? So keep in mind that just because you deduct so much money doesn't mean you get that much money back. It means you get a portion of that much back.
Mm-hmm.
Okay.
So yeah, I would never suggest that you eat the sales tax to your clients. Because yeah, you're gonna pay $5,000 for $750 of deduction. You've lost out on $4,250 of money right there that could be in your bank account.
That 5 months of house payments because you want to be nice. I don't know. You're very nice.
Wouldn't do it.
Okay.
Okay, I'm gonna move on from that. Got quite a few questions about home office. What can you deduct in a home office? There are 2 home office deductions, 2 different ways to do it. There is what is called the safe harbor election. The IRS has made an option that you can say I have that you get $5 per square foot up to $350 or up to 300 feet of an office as a deduction every year. So $5 a square foot, 300 feet. If you've got an office that big, that's a $1,500 deduction every year. What the safe harbor lets you do.
I want bigger deductions than that. This is a big room, Matt.
Yeah. So what the safe harbor election lets you do is once you've elected the safe harbor, it's now totally on the IRS to prove that your room is not an office. It needs to be a room. I mean, home office, it really needs to be a room dedicated to the business. It's not used for anything else. It's where you meet clients. It's where you store stuff. It is a home. It is a real office. You can pick it up, put it somewhere else, and someone would recognize it as an office.
So Matt, would this qualify as a home office?
Yes.
Okay. This one, and it's big.
So the safe harbor election gives you that protection. The IRS has to prove, that's not a home office. The second way to get the home office deduction is the actual expense method. You got to calculate the square foot of your office, the square footage of your home, and come up with a percentage. So for easy numbers, let's say you have a 3,000 square foot home, you got a 300 square foot office. So 10% of your home is an office. So now you get 10% of several home deductions as an expense. So 10% of your mortgage interest, your property tax, your house insurance, your utilities as a deduction. So in my example, we have 10% of the house is the office. So you need to have $15,000 of expenses on mortgage interest, property tax, insurance, utilities, and repairs. You need to have $15,000 of all those expenses before you have exceeded the safe harbor election. So, I mean, if you have a lot of those expenses and you've got a legit office in your house, I mean, you can take that method, but you no longer have the protection from the IRS because the IRS can simply say, we don't believe this is an office, you need to prove it to us. Whereas with the safe harbor, the IRS has to prove to you that it's not a home office.
Okay, so what about a portion of, if it's a spare bedroom and you're using it as an office, yes, right?
Yep.
What about a portion of a room? Let's say, somebody uses half of a room for an office and half of a room for a bed. Can they deduct the square footage of half of a room?
You can. I would suggest doing everything you can to make it look like an office. So if that is put up a wall divider to say this half the wall is my office and that half isn't, I would suggest that. If it's putting up desks in certain ways to make it seem like this is a business area and this is not, I would do whatever it takes to have it be a business look-like room.
Mr. Chris just came down, so you know it's serious.
So if I'm
You can
if
come
I'm
back
deducting,
here. Come on back here so they can see you. You guys want to see the cute man? My cute man I'm married to. Come right
so
here,
this
honey.
is-
You
this
can
is
be
for
like...
Matt. So if I'm keeping track of my utilities, when I turn my utilities in, I give you that total number, and you take away the percentage, right?
Correct.
Okay, so I don't have to do all the number running and stuff like that?
No, you just have to give
Okay.
your CPA the total amount of your utilities, mortgage interest, property tax. You just give them the total amount and the square footage of your home and your office, and your CPA will figure that out.
That's why I
See-
use the same one every year.
You guys, this is why you use a CPA. If you're going to deduct, Matt might go over this later, but I will say this. If you're going to deduct space in your home, if you're going to be doing all of this stuff, having a CPA will help you. They are worth their money, all right? And you know what? I think before we had someone that said, take a picture of your home office. So if you ever get questioned by the CP, by someone, you can show, like, this is my office. This is what it looks like, because I have an office. So, okay, good question. And this is one thing I forgot about, but can you deduct if you rent?
Yes, you can do the same portion of your rent would count for it. So,
you guys, this is one of the few times you can deduct something from your home if you rent, is with a home-based business. So if you rent, you should definitely have an office if you can and be deducting. Like, there's lots of things you can deduct on your home, but you can deduct on rent.
Yep. So, I mean, it's an opportunity to deduct something that an employee would never be able to deduct. So, home-based business gives you a benefit with that for sure. Trying to think if I forgot anything about the home office now.
Sorry. So, portion of the room, you would recommend making it very definite that there's a division. Some people said, what about a showroom? If a showroom is your office, right? Mm-hmm. Okay. But if you just have a couple pieces of jewelry in the corner.
Yeah. I mean, it's got to be obvious that it's some sort of space for the business. I mean, they're not going to you're not going to get a deduction if, you pull out your pieces on your kitchen counter and then count your kitchen as an office. That's not an office type thing. It's got to be a definite room that's dedicated to the business, and you've got stuff set up, and it's where you do business.
So for those of you that are coming in late, and I'm going to say this probably 2 or 3 times, go back and watch the whole thing, okay? All of you, have your teammates watch this. Watch it. Because chances are Matt and I will answer a lot of your questions. I don't want everybody contacting him with an answer that you can find in the video, okay? We're professionals, so make sure, I'm going to say this at the end, make sure that you watch this 1 or 2 times before you send Matt a question.
Okay.
Because he has a life and a wife and cute kids and a job that he has to do.
And it's busy season.
It is busy season. This is, you know what, he's taking valuable time to come share with us.
Okay, next topic I wanted to go on to is a lot of people asked about keeping receipts, receipts fade, how to keep everything organized. My suggestion would be bank statements keep better than receipts. So, number 1 is definitely have a bank account and a credit card dedicated to the business. Do not mix your business expenses and your personal expenses on one card and then try and separate it at the end of the year, because you're either going to miss your deductions or put stuff in there it shouldn't be, and if you're ever audited, it's harder to defend.
Doesn't the IRS, the difference between one of the difference between an actual home-based business and a hobby is this, what he's talking about. If you're deducting a lot, you better have a separate bank account and like a separate credit card that you use for your business, because if you're audited, the IRS, they do want to see separate accounts. Mm-hmm. They do not want to see commingling of funds.
So I helped with it was a state unemployment audit this last year, but the guy refused to get a business account, commingled everything, and the auditor is looking over it, and her words were, you can't prove to me that this is business, so I'm assuming it's personal. So just by separating the accounts and saying I do everything business in this account, everything personal in this account, is going to save you it's a huge audit protection. So separate accounts is number 1.
And Matt, really quickly, if you get audited and you can't prove that it's a business account, what happens?
You lose the deduction.
You lose the deduction, and don't they sometimes say you owe us $20,000?
So yeah, it depends on how much you're losing, but if you deduct expenses the IRS deems are not business expenses and it adds up to a lot, the IRS you're going to have an underpayment penalty, you're going to have a late paying penalty, all the tax due, and if it's substantial enough, so if the amount's over $5,000 of tax, they're going to add a substantial underpayment penalty, which is 25%.
Whoa. Now, if somebody's just doing a little bit here and there, do they need this?
For Paparazzi? No. If you're just doing a little bit of sales on the side, kind of a hobby, just a really small business, I mean, you don't really need the separate account, but I would still print off your bank statement, and I would highlight your business items, and right next to it I would write, this was for this event, this was this expense, keeping track of that. And I would do that monthly so you don't lose out on deductions, for sure. So I would suggest, I mean, we all see receipts, they all fade real fast. So monthly I would print off your bank statement, and I would write on those the ones that need to be clarified. This was a meal with a client, this was a travel expense, this is advertising. I would write on that bank statement, and that's the statement I would keep for the next 5 to 7 years as my audit backup.
5 to 7 years, people.
So, with all this as well,
if you have a big business, you better have this, right?
Yes.
Like, once again, what, like over 10,000 in a year for sure?
Yeah.
That's what he would recommend.
To go along with this, just kind of organization of receipts and accounting. If you're getting more than the $20,000, I would suggest everybody get an accounting software to track their income and expenses. Our office, personally, our office likes QuickBooks, and QuickBooks Online is becoming extremely effective. You can link your credit card and bank statements to it, so every time you log on, it pulls transactions from your bank information, puts it in there, and you can classify it, and you're continually making your profit and loss.
We use Deductor. Okay, Chris and we use Deductor. I think it's probably similar to QuickBooks or whatever, and that is found in the back office under Resources with Paparazzi. Our credit cards, our credit cards are attached. We can do multiple businesses. We can keep track of charity and medical and all of that. So a good accounting software, if your business is, big enough that you need to, that you're going to deduct a lot, you definitely should be using it.
So yeah, definitely, as you're making more and more, the more money you make, the more you need an actual accounting software to be tracking your stuff. So at the end of the day, whether you use a QuickBooks or you're taking your stuff to your accountant, they generally want to see your totals. What was your total advertising? What was your total cost of goods sold? Your taxes, your items like that. If they have questions, they might ask for further information, like your advertising's up, 250% over last year. How come? Can we see the information underneath that? But in general, your accountant just wants to see the main information. But still, the accounting software, the more you track your expenses, your income, the more opportunities you have to plan and change when needed your business. So if you don't realize that you're spending $80,000 a year on advertising until the end of the year, you haven't had any chance to change anything. If you're ridiculously overspent, you don't have a chance to change anything for last year and save money. So tracking your accounting, keeping your information together monthly, definitely, the more money you make, the better it is to do that, and the more it'll save you eventually. So now I'm just kind of going to go into a couple expenses that other people had asked about, and just whether they can deduct it or not. So the first thing there's a lot of people asked about internet for their home and cell phone, telephone. So
do you still need receipts if it's in a separate bank account from your personal?
I would somewhere along the lines, I would label the expense, whether it's in your software or on a bank statement. But if you've got your bank statement labeled, software labeled, I would be fine getting rid of the receipt. I would keep receipts for big things. If you purchase anything over $1,000, I'd keep that as long as possible.
Chris always says, is it $70?
So
I don't know.
It kind of depends on your accountant on that as well, but for our office, just the really big items. If you're buying new computer in the business or something like that, you want to keep that receipt. But if it's, I don't know, you go rent a car for a day to go to a show and it's $100, I wouldn't keep that receipt.
Okay.
So
You guys, one really easy way to keep receipts is just label one January, February, March, and put the receipt in. And then put all those receipts in a box with all your tax info for 2017. Come 2024, throw it away.
Yep.
You need to save it for 7 years, right?
5 to 7 years.
5 to 7 years. 7 years to be safe.
Okay. All right. So internet and phone. First off, internet is not included in the home office deduction. So that can be an additional deduction on top of the home office. Unless you have a second internet line and a second cell phone or phone line for the business, the IRS does not believe that your phone and your internet is 100% business deduction. You are going to be doing personal stuff on it. So they are deductible, but you need to come up with a reasonable percentage of those amounts that are business. So, I mean, if you're someone that's constantly on the phone with your clients and others around, others in your team, 85-90% deduction, not a problem. But if you put 100% deduction, the IRS, they are audited to disallow everything. They wouldn't disallow the 10% that wasn't business. They would disallow everything because you took the whole thing when you weren't supposed to. So you need to come up with a reasonable percentage for internet and phone, what you really use for the business. 50%, 60%, 80%. Just make it reasonable. Maybe when you do your calculation, try and keep that general receipt. This month I average, and you don't have to track every phone call and text, but I feel like this month, this amount of my phone calls and text messages and my internet usage were business. Write your thoughts down on it, record your percentage, give it to your CPA. So the big thing, the general rules, a lot of these expenses that are mixed, when you use it personal and you use it for work, the IRS will never accept 100% business use.
If you do, that's a red flag.
So,
right?
So it's not necessarily a red flag because the IRS,
they're not looking specifically.
They don't know how much you paid in total on your phone.
Right.
But in the audit, if you're ever audited and they say, all right, I want to see your phone bills, and they say, all right, you spent $2,000 on your phone and you deducted $2,000 on your tax return, that's not right. So, a lot of this stuff, the IRS isn't going to know unless you're audited. But if you're audited and a lot of this stuff you're taking and you shouldn't be, the IRS will ding you hard for it. So that's all I think I need on internet and phone. The next one is automobile expenses.
Is it better to estimate too low or estimate too high?
Everyone would say estimate low, but CPAs have different levels of aggressiveness. So your CPA might estimate high. Recommend going higher. So it's up to you and your CPA what you feel is reasonable and what is, we would try and say, defendable in an audit or audit proof.
Matt, how many clients have you had audited?
Had audited? For income tax, I haven't had none.
Oh, really?
So, 5 years in practice, so.
Well, that's good.
Haven't had too many, but.
Let's make us not be the first or the ever, right?
Okay. But yeah, so my next expense is automobiles. You're traveling to clients, you are traveling to events, you're picking up stuff, going to the post office. What is deductible? Once again, there's two ways to do it. There is what's called the mileage deduction or the actual deduction. Mileage is a rate the IRS determines every year. For 2018, that rate is 54.5 cents a mile. And what that rate includes is your fuel, your insurance, your repairs, your license, pretty much any expense on your automobile, including the cost of the automobile, is included in that 54.5 cents. The second way, the actual expenses, is you list the price of your vehicle, your fuel, your insurance, all those things. So some of those things, once again, you're going to have to split between personal and business. So I have this vehicle. I use it 40% of the time for business. I only get 40% deduction of the cost of the vehicle. That's where it gets hard this way, is if you're still using it business and personal, I mean, you've got to track your gas receipts. How much of this gas receipt was business? Your insurance, that one's kind of easy, the 40% or whatever your percentage is. But your fuel and repairs.
My advice, don't do it this way.
So,
You guys track your mileage. It's the easy, provable way, right?
It's easy. You need to keep a log. You need to have a sheet that says January 1st, I drove to this client for a party, this many miles.
Yeah.
If you're ever audited and you've got a mileage, you've taken the miles, you need a log to show to the IRS.
Right. Don't just say I drove 5,000 miles at the end of the year with no proof of where you drove. So when I first started, now I have deductor. When I leave my house, I press my odometer or my the thing that says how many miles. I go to the post office, I go back, it's 6 miles. I come home, I go to my deductor on my phone, I type in 6 miles for the day, post office, deliver package, and I'm done. Okay, when I first started, before I had the app, I had a little pocket calendar that I kept in my dashboard, and every time I'd leave my house, I wrote the beginning miles and the end miles, where I went on the day, that day of the year, and how many miles I went, and then we added it up. You guys, we got thousands of dollars of deductions because I drove to Washington, and even when we go to my mom's house or different places like that, if you take your bling bag and sell some jewelry, you can deduct it. Miles are huge. So I personally would recommend doing the miles versus doing the car.
The benefit now, the IRS had some changes this last year, the big tax law change.
Oh, I don't know this.
So people trade in their cars. When you trade in, you don't have to recognize the old car as a sell, but you get less deduction on the new car. Well, the Congress changed the law. When you trade in a car, you now have to recognize the old car as a sell. So if you got the car on your records as a business vehicle, you trade in a newer vehicle and it's worth $30,000, you got to recognize $30,000 of income on your taxes. Where if you use the mileage rate, your car isn't on there. So you trade in the car, you sell the car, you don't have to report that now, but you still get the deduction for having it because that's built in on that mileage rate. And those of you that drive a lot, I mean, I've got some clients that drive 40,000 miles a year. They don't have to drive, 40,000 miles a year, about half of it's deductible, so about 50% of it's deductible, so it's $20,000 of a deduction in 1 year. If they keep that vehicle for 10 years, they've got $200,000 of deduction from one vehicle. And because a portion of the mileage rate is attributable to the cost of the vehicle, you way exceeded the limit of whatever you purchased the vehicle for. So
Miles make sense, right?
yeah, for the most part, miles is the best way to go.
And I think for our situation, especially for, those people that are doing this part-time and, not like every day, all day, miles is probably the best way to go. Mm-hmm. It's the easiest, you guys. Miles is the easiest, don't you feel like?
Oh, yeah.
So if you want to go the easiest way, which I'm kind of a choose easy and still get the most benefit, we just track our miles.
Yep.
The app that I use is Deductor. It's in your back office under resources. It's like $10 a month. Totally worth it.
Yep. Okay. I just got a couple more. I realize we've gone about an hour, so trying to close up real quick. Office expense. You've got your home office. You've purchased a computer, printer, supplies. All those things are deductible when you use it in the business.
Tables.
Pegboards. Your
shelves,
boxes, postage. All those.
Postage. Okay, so wait. Let's talk about postage. So I charge $3.50 to mail a package, no matter if it costs me $3 or $7, whatever. I can deduct the stuff that the customers don't pay, right? The overage.
So explain that one more time. Sorry.
Okay. So if so you guys know how I send postcards out to you. If you hit rank or whatever, that postage is deductible.
Yes.
Because that's an expense. The postcards I print, they're deductible, they're expense. Okay, but on shipping packages to clients, okay? So if I charge $3.50, I did a party last night, I charged $3.50 for shipping. Sometimes it's a few cents less, sometimes it costs me $7 to ship a package. So the $3.50 that is over the $3.50 that I charge, that's deductible.
Yes.
But not if it costs $350 and they paid $350, you can't deduct that because they're paying for it.
So you don't. So when you charge the client, it depends on how you track it. So if you track the shipping you pay your client as income as well, then yes, you take the $350 in deduction. But if you don't track the $350 you charge the client in income, then the $350 isn't a deduction either. But additional amounts you paid, so you pay $7 and you charge $350, you paid $7. The overage, yes, that's an additional expense that the client wasn't charged. You had to pay. It is a deduction.
Okay. So some of the shipping could be a deduction, guys, but not all. So don't go say, well, I spent $5,000 mailing packages and I brought in, $4,000. You can't deduct the whole $5,000 because that would be not being honest. And it could get you in trouble. So just be careful on that. If you lose money or, if it's more than what you paid, and keep in mind envelopes are a deduction. Envelopes are a deduction. If you're buying bags, if you're buying, I don't know, foam, stickers, whatever, those are deductions. Any expense for your business can be a deduction.
Subscription. So, if you buy a QuickBooks subscription, PayPal fees, bank fees, those types of fees.
Is a CPA
a CPA? Your CPA and an attorney, those are legal and professional fees.
They're a deduction.
If you're paying money for your business, include it in your expenses, and if you have questions, point it out to your CPA. I included this. Is it really a deduction? I would rather my clients include it, and we look at it, and I have to disqualify it, than my clients assume it's not deductible, not tell me about it, and they don't get a deduction when they do. And most CPAs will be the same. So if you're not certain, include it, but ask your CPA when you give it to them.
What about we use PayPal and Square, whatever, to invoice people, and they take a portion of our profit? Is that deductible?
Yes, that's a commission paid to PayPal or Square, and it is deductible.
So you guys, if you're using PayPal or Square, usually at the end of the year they have a spot where it says how much you paid them, right? And so that portion is deductible. Yep.
Okay. Moving on, the next expense. A lot of people have asked about the jewelry you wear to promote your events. So the stuff you buy to go take somewhere, you're wearing it, you're showing what you have. You look like you wanted to say something.
Your fingernails. I know a lot of people get fingernails done. What about my makeup and my hair, my clothes? Is that all deductible, Matt?
So we'll kind of work our way through it a little bit at a time. So once again, the IRS is looking, some of these things, if I get my hair cut, half of it's got to be at least personal. You wear your hair outside of work, basically. The IRS is...
You need it, yeah. Keep your hair short, Matt. No dreads.
So we'll start with the jewelry you do. The jewelry you wear to your clients, to your parties type things, I would say yes, it's deductible. But I'd say keep it conservative. If you spend $10,000 on jewelry you wear to parties, the IRS looks at it, it's going to be tossed out. But, you spend a few $100s on your jewelry you wear, you change it every year. That, to show off the new products, totally deductible.
What about my nails? I got to go every 2 weeks to get my nails done.
So I'd say that kind of depends on the aggressiveness of your CPA. I would say for the most part, if you honestly wouldn't go get your nails done other than I've got this party and I need them done, I would say deductible. If you're a person that likes to have your nails done all the time, I would probably say you need to get a percentage of what's going to be actual business. And I would say you could definitely lean up more than 50%. If you're someone that likes to have your nails done, but you're doing these parties all the time, I would definitely say you could deduct 70-80% of your nails or your hair. If you're getting your hair done frequently so that you keep it off your ears to show your earrings or whatnot, I would say a high percentage of that you could take as a business deduction.
I love to buy new clothes. I go shopping every week, Matt.
Same
and
thing.
I wear clothes, so is that a deduction?
So the IRS is going to say if you can wear it in the regular course of your life, then it's not a business deduction.
What if it is Paparazzi branded?
they would still say, my shirt here, this is Cook Martin Poulson. If Cook Martin Poulson made me buy this shirt, the IRS would still say, you can wear that out and about. And it's not, I mean, you can still do your normal everyday life wearing that shirt. So it's not quite a business deduction. I would say, though, most CPAs are the same. They'll give you a little leeway. You bought this special dress just for parties, and that's all you wear it to. You buy special bags or whatever that are just for the parties. I would say, yes, you can deduct it. Once again, it's be conservative. If you're spending $10,000 on clothes, that's not going to fly with the IRS if you're at it audited. But you buy a couple $100s of clothes, they're for my events, that's the only time I wear them, those are deductible.
What about like a fancy dress for convention to be on stage?
I would deduct it.
Okay.
So
Talking,
keep
yeah.
tipping on that side.
Well, no, it's just like I'm like, how does it keep turning away from me? Okay, what about? Oh, okay. So you guys, the whole point is be reasonable. If you are only selling, Matt, correct me if I'm wrong. If you're only selling $500 or $600 a month or in a year, and you deduct $10,000,
I mean, you got to have good receipts and stuff to back it all up, but that's going to be a red flag, especially after the first year or two. If you're only doing $500 in sales and you've got $10,000 of expenses, the IRS is going to question, is this a hobby or is this a business? And if it's a hobby, no expenses are deductible ever.
right?
So
this is why hobby versus business is important. One, and what are like the litmus test? You know what I mean by litmus test of a hobby versus a business?
It depends on your auditor you end up with. But if you can prove to your auditor that you are trying to make money, you're trying to make what you do a business, if you can show that you're doing that, then it can be a business. But that's going to require stuff like I spend 5 hours a week doing advertising or research. I am looking for new products. I am attending these events to try and help me gain clients type things.
I've heard you have to be able to show that you're working it consistently.
Mm-hmm.
Okay?
Consistency would be the big thing.
Consistency, and then also the bank account thing.
The bank account would help as well. I had one on the tip of my tongue.
Uh-oh, sorry.
You're just fine. But yeah, you need to be able to show you're consistently trying to actually make money out of this. Nobody has a business where they are purposely actually losing lots of money. You want to have a business, you are going to make money. So you have to have a plan, a way that you're showing I'm doing these things and I think I'm going to make money out of it.
So if you keep your calendar, for the year and you have stuff written down, you can show I'm working my business. If you are deleting all your Facebook, if you have a VIP group and you're posting in it consistently, you can go back and say, look, I'm working my business. There's lots of things you can do to show that you are working it consistently and maybe not making tons of money. But if you're deducting tons and tons of money and not bringing in money, that is a red flag that might cause an audit. And audits that I've heard are not fun.
So the one I'll point out that happens a lot, and it just kind of depends on how your CPA puts it in there sometimes, and it depends on the information you give them. But so on a tax return, you have your gross sales, you have cost of goods sold, and that's going to be your actually jewelry and stuff that you're selling to the client, and you have gross profit, and then underneath that you have all your expenses. So if you have gross profit of $500, the IRS expects cost of goods sold to be less than $500, because I'm not going to buy something for $5 and sell it to you for $3. I'm going to buy it for $3 and sell it to you for $5. So that's kind of your inventory. So I mean, if you purchase a lot of inventory, that's when you're going to track some of it and put it on your balance sheet. So if you have $500 of sales and $10,000 of cost of goods sold, that is a major red flag with the IRS, because you just told the IRS, I bought something for $10,000 and sold it for $500, and that's not a business. The IRS, not that it's a guaranteed audit, but that's one the IRS would look at, and if they decide there's going to be money to get back from that tax return, they'll go after it.
Okay, there's a question I don't think you've covered yet. So in Paparazzi, for every 10 pieces we buy, they send us a free piece. So when we're counting inventory, what do we do? What do we do with that free piece that we got? Because I don't know how to say, I got this, you know.
And I'd say letter of the law, that you didn't pay for it, so it's got a 0 amount basis in inventory, so it's not counted in inventory. Now, whether that's trackable is the other thing. If you're buying thousands and thousands of pieces, there's no way you're going to be able to determine, well, these 10 right here are my freebies. So
we could go in our back office say, okay, I bought 8,000 pieces last year. Roughly 800 of those would be free. Right?
And I guess based off that, you can kind of say, well, based off my estimate of those 800 pieces that were free, I mean, I've got probably 20 here that I still haven't sold type thing, maybe. But I would say probably for intents and purposes, if you don't have that much that's free, like, I wouldn't necessarily separate it.
Okay, what about when we give free stuff away? Do we deduct that if it was given? Okay, so like we'll do, okay, share my video and get 5 free pieces, and then, you know, if we're giving free stuff away, do we deduct that? Or if we're getting 5 free pieces for selling 50 pieces, can we deduct the 5 free pieces we're giving away?
So it goes back to what you paid for it. If you got 5 free pieces from Paparazzi and you turned around and gave those 5 same pieces away, then there's not a deduction. You didn't pay any money in there, so there's not a deduction. Now, you host an event, the lady that hosts it, you say, you get 20 people there and I'll give you 10 free pieces. And, I mean, you paid for those 10 pieces that you give her, that's a deduction. So if you paid for it, it's a deduction. If you didn't pay for it, it's not.
Yeah, so if you're giving away fewer free pieces than you really can't deduct those.
Correct.
Because they were free to you, so you're just passing the free pieces on.
Okay.
What about booth fees, travel fees, convention, empowerment, the little regional conferences? I'm going to the Dominican on Friday. Is that, with Paparazzi, is that a tax deduction?
Deductible.
Woo! Yes!
So,
you guys, you can get paid to go on, or you can deduct money to go on vacation, which means you get money back.
So, booth fees, I mean, you're trying to sell goods. That's deductible. Your travel to get there, your travel to get to conventions, your travel to get to clients, it's all deductible. Your meals there as well. Remember, meals are only 50% deductible. And new this year, entertainment is no longer deductible. So you take your clients to a professional sporting event, opera event, whatever, you're going to take them to something like that as a thank you. No longer deductible at all. So you remember that one. But meals are still 50% deductible. Your travel.
Your fees to go, booth fees are deductible. What if they donate to charity from their business?
So, kind of depends on your CPA again. The CPA might pull that deduction out of the business and put it on your personal return if there was nothing received in return. But most businesses donate, so they donate to the local high school, and the high school puts up a sign along the football field that says, Paparazzi jewelry for $5, call Michelle Johnny type thing. That's advertising. So it was a deduction, but you still got something out of it. So it's advertising, so it'd be included as an expense on your business. But, I mean, say you give it to a charity that provides help for orphanages in a foreign country, you're never going to see anything for advertising out of that. So that expense is eventually going to come to your personal return and be included as an itemized deduction, which, starting this year, you have to get more than $24,000 of itemized deductions before you itemize. $24,000 is the new limit. The standard deduction is $24,000 for a married couple, so you have to spend more than $24,000 in your itemized deductions in order to itemize. So, I mean, if you don't have very much mortgage interest, property tax, medical expenses, and then charity, I mean, a $6,000 deduction probably won't get you much. But if it's going to get you at least a sign that says, here's my jewelry store, that'd be included as advertising. So that one, it kind of depends on your CPA, and it kind of depends what you got out of it.
Those that are coming in late, go back and watch it from the front. I would file taxes if you have a business, you guys, because you should get more money back in your taxes if you have a loss in your business. Don't you kind of feel that way, Matt?
Yep.
So if you have a business, you might want to file because you'll get more money back and all of that. I know a couple people that have gotten in car accidents doing business. What's the
So that one's a tough one. You take the mileage rate, you can't deduct repairs, you can't deduct replacing the car. But even so, hopefully everybody had insurance on their car, were able to recoup some of the cost of the loss from their insurance. So if you take actual expenses, so you take actual expenses, not the mileage rate, whatever it costs to fix the car minus what the insurance company gave you for it could be tax deductible. So it kind of depends on your situation. If you're in that situation, talk to your CPA. He'll give you the right answer. And it depends on your situation, so he'll know.
what about
He or she'll know, I guess.
health insurance? What if Chris and I are self-employed and we have to pay for health insurance? Is that tax deductible
Yes.
through our business?
Yes. So if you're paying the health insurance through your business, it's included as self-employed health insurance. It's an adjustment to income. So you have on your personal income return, you're going to see total income from everything. Then you have adjustments to income, which include things like retirement contributions, HSA plans, and your health insurance. It can reduce your taxable income on your personal return.
Yep. What about, okay, I saw a couple questions about like Social Security. Do you know much about like taxes on Social Security and home-based business, how that all works?
So Social Security, if you're trying to earn credits, I mean, that's you're paying into the Social Security system. If you're a partnership or a sole proprietorship, all of your income is subject to self-employment tax. Which one of those is Social Security? So you're paying into your system. If you're an S corporation, you have to file payroll reports. You have to issue a W-2 from your business. And when you do that, you determine the amount of income from your business that's going to be subject to self-employment tax and Social Security. So that'd be a conversation to have with your CPA if you're trying to earn credits and need to determine a good amount of money that is subject to Social Security tax. That'd be what you want to do. If it's talking about general Social Security, I mean, you're receiving Social Security on your tax return. That's kind of a question for your CPA and your specific situation. Up to 85% of Social Security is taxable on your income tax return. None of it can be taxable if your income's low enough. But I'd probably say talk to your CPA, talk to your accountant about the situation for Social Security.
Okay, so Anna, go back and watch from the beginning. We've talked about that. Okay. So you guys, in conclusion, he's busy. He has to go do a ton of taxes. I would recommend, if you're serious about your business and if you're making money and you want good deductions, to use a CPA. Okay. All these little questions, a CPAs usually, do they usually charge by the hour? Yes and no.
There's yes and no.
Okay.
Some will charge by the form, some will charge by the hour.
Okay.
I would, depending on your CPA and your location, professional services cost more in states like California or New York. You're looking to spend anywhere between $300 and $2,000 on a tax return.
But $2,000 is for quite complicated businesses, right?
Quite complicated businesses, and it's kind of, I mean, if you're a attorney or a CPA in Los Angeles, California, they can command a higher salary just because of the area they're in.
So using a CPA elsewhere would save you money.
That really is an option if you've got family and friends that have CPAs outside of some of those big states, don't charge as much. I mean, you can totally use someone that's not near you. So, so it's going to cost money to get your taxes done, but what you buy is a CPA that does your tax return correct. And as long as you give them all the information they need when they prepare your tax return, they're the first line between you and the IRS. The IRS sends a notice. As long as you gave your CPA all your information up front, they had all the information to prepare the return, they're the first ones there that'll be fighting with the IRS, just saying, here's what we had. I mean, this is deductible. That's not, whatever.
So you have to give correct information. He can only do what he can do with the information that we give him. If we're giving him incorrect information, it doesn't mean that he's going to save us from the IRS because we were lying or whatever, right?
So in our firm, as long as you give us the correct information, we pay penalties and interest on anything that we weren't able to defend or do right. So, I mean, you get a $10,000 tax bill plus penalties and interest. We don't pay your taxes for you, but we pay the penalty and interest. So, if you didn't give us all the information, we couldn't have prepared it right anyways. So you're on the hook for everything. And I think most CPAs will kind of be in that same boat. As long as you give them the information, they'll take the bite for what they've screwed up on.
Yep. So I really feel like he's covered a ton. If you came in late, go back and watch the beginning. Watch it a couple of times, in fact. Matt said he would answer some questions, but you guys only message him. Okay, and I'm serious about this. I'm going to ask him, did you get messages from my team? And it was a question that was answered in the video. Do not waste his time. Okay, I would go back and share this with your teams. If you would like Matt, or you do have different people in your firm that can help with, like if a lot of people want their taxes or done, right? You have other people that are taking on clients that are just awesome like Matt. If you would like Matt to do your taxes, I will put his information and the firm's information in another post after this, and I'll put it in the comments here too, so no matter where you go, he can help you whether you live in Utah or somewhere else, right? What else do they need to know?
So I'll leave Michelle my information to put out. I would say, if you got questions, wait until tomorrow to contact me, but I'm open for questions. Anything you've got, I can answer as best I can. If you would like me to do your taxes, if you would like our firm's help, I'd request that you contact us before February 15th.
Okay. The sooner the better.
The sooner the better, but I mean, before February 15th would be kind of my deadline. Our firm probably wouldn't take very many clients after February 15th. Just because we're in the thick of everything right then.
And you basically send out a sheet saying, I need this information from you. So he's going to send you or something that says, this is what I need from you, and it's up to you to go do it. And then get the information back to him in a timely manner. Do not send it in the day before taxes are due. It will not get done.
Correct.
You would be filing an extension instead of sending in your taxes. Okay. Anything else?
I think that's all I brought. So.
Okay. Hopefully this helped you. I feel, and he can do taxes in any state.
Yeah, I can do taxes anywhere, so.
He's great. If you own a jewelry truck or trailer, you guys, these are questions, honestly, if you have some of these complicated questions, that's why you need a CPA. Okay? That is why you need a CPA, to help you decide the best way to declare your taxes, the best way to get the most money back without raising red flags. He does that. And he's worth every cent we pay him to keep us out of hot water and to get us the most money back. You guys, if you didn't hear at the beginning, one of the reasons you do want to file taxes is to save yourself money. Because think about it, if you have $15,000 of deductions and you make $60,000, it's like you only made $45,000, right? So you're only paying taxes on part of what you actually made because of your deductions. Do you charge hourly or?
So we have a small component, about a $75 charge is fixed for every return, and then it's hourly on top of that.
So I did ask Matt this. The more prepared you are with the information he sends you, the less it's going to cost you. So if you want somebody professional like Matt to do your taxes, you need to be proactive and you need to send them good information so they don't have to keep coming back to you and saying, well, what about this? You didn't send me this, send me this, send me that, this, that. If you are prepared, if you do a good job with your records, you can send it to them. They'll look it over. He might ask some questions. Well, did you have this? Oh, yes, I did. Okay, well, that's a deduction, you know. So there's places he will save you money or you make you more money depending on your health. But it is up to you to do your end, and that will save you money. And his fee or any CPA's fee is tax deductible. All right, so go back, you guys. Watch this. Feel free to share it with your teammates. Have your teammates come watch it. If they can't see it, it means they're not in my group. They need to be added. If their Facebook name is different from the name in the back office, I don't add them, so you need to let me know. I mean, unless they put their consultant ID number. Whenever somebody requests to join my group, I ask, what is your consultant number? That is the easiest way for me to approve people, and yet the majority of people do not do that. So have them write their consultant number because I will get them in faster than if I have to go try to search for them under a name that's, you know, I'm busy too. I'm busy too. So, do you speak Spanish, or are there people in your firm that do speak Spanish?
We've got one new hire that speaks Spanish. He went to Ecuador on an LDS mission and learned to speak Spanish there. So he could probably help those of you that speak Spanish.
Yeah. So if you are a Spanish speaker, they do have one person in their firm that could help you. Okay. Anything else, Chris or Matt or me? Okay, everyone, thank you for coming. Like I said, watch the video. I will get his information. I will put it in the comments, and I will also make a separate post. Only contact him. You hear me? I'm serious about this. I will come through the phone, and I will swat you if your question is not asked, and if you actually are going to use Matt for your taxes. Otherwise, go find the person you are going to use for your taxes to help you. All right, Matt doesn't have to help everyone, but he can. All right, so I hope this has been helpful. He gets paid like $500 an hour, so this training was worth like $750. Just joking. That will scare him away from using you.
I wish.
He wishes he got paid as much as the paparazzi consultant.
That's true. You guys make great money.
This guy, next thing you know, he might be CPA to paparazzi. We do have CPAs that have joined paparazzi. They're smart. They know about multiple streams of income. They need tax shelters. That's the word they use. Tax shelters, all of that. So, okay, you guys, thank you so much. Go out, work hard today, rock your business, make 2019 your year. All right, bye-bye.